Welcome to this Killik Explains Finance video. This week, how to buy shares, a quick snapshot. Let's take a look at execution-only advisory services and discretionary management, make sure we're clear on the differences and the pros and cons. So first of all, execution-only or XO pretty much does what it says on the tin. That means you are giving instructions to a broker or investment manager and they are simply connecting you to the relevant buyers and sellers in the market, and that's called a stock market when you're dealing with shares, and that's really all they do for you. So what does it mean? It means basically the broker is acting just on instruction to buy or sell shares or bonds for argument's sake. Trades can be therefore done fully electronically and or over the phone, and it's suitable for DIY investors. In other words, you're not getting any help, you're not getting advice in terms of the way your portfolio looks and the way it's managed. And there are no add-on services available either. Should be the cheapest way to trade, therefore. It's fast for reasonably knowledgeable investors, but let's face it, not everyone wants to be by themselves. And also, not everyone wants to spend time investing. So for people who want a bit of hand-holding, we've got the advisory services coming up. And for people who actually could do it themselves but don't want to have to, we've got discretionary investment management. More about those in just a moment. So moving on. What do advisory services look like? Well, basically here, you've got a broker or investment manager being paid essentially to offer usually two levels of service. One, advised dealing, one, advised portfolio. Sound quite similar? What's the difference? Well, with advised dealing, you are making investment decisions with the help of an investment manager, but they are stock specific. So you're having a conversation about whether or not to buy BP, for argument's sake, or Amazon. All right, and that is the extent of the advice you're going to receive with advised dealing. So you're not going to get help with portfolio construction or management. So if as a result of making this deal, you're going to end up with a portfolio that's hideously skewed towards certain sectors, well, that's on you, if you like. The investment manager is not there to correct that. That means it's a bit more expensive than pure XO, but not always as expensive as a full service discretionary management mandate, for example. Now, if you're thinking I'd like a bit more than that, I'd like to be involved, I'd like a bit more than that, then advised portfolio gives you that, because basically you are making investment decisions with the help of an investment manager. The extent to which you make them and they make them is down to you to negotiate, if you like. Stock specific and portfolio construction and management advice are both covered this time. So you will get help with thematic investing, you will get help with diversification, by geography, by sector, and so on. You will get tactical advice, all of that good stuff, and access to other relevant services such as tax planning. Okay? So it's a much more comprehensive level of service for those people who want a level of involvement in the day-to-day running of the portfolio. Now, there are people out there who will be thinking, actually, I don't. For them, a discretionary mandate could be the way forward. Because here what you're doing basically is handing over full discretion to a broker or investment manager. They will take day-to-day decisions about what they move in and out of, those stock-specific decisions, and also take responsibility for the overall construction and management of the portfolio. So that can appeal to people who either don't have the time to run their own investment portfolio or do have the time but don't have the knowledge, for argument's sake. So what it is, you're giving complete control over your investment portfolio to an investment manager. They will be taking the day-to-day decisions and then updating you on a regular basis about how your portfolio is doing through a portfolio valuation. Pros and cons, it's a lock up and leave option, that's the good news. Many investors are thinking, I just don't want the hassle, I want to hand it all over to somebody else, give them the mandate. And that mandate can include, a preference for income, a preference for growth, and so on, but you're handing over the mandate. Full portfolio construction and risk management is therefore the responsibility of the investment manager, and that makes it usually more expensive than, say, a pure XO service. Now, the final question I want to deal with is why do you want to run a portfolio at all, with or without the help of an investment manager, when you could just buy an off-the-shelf fund? It all depends. In summary, here are the key factors to consider. There's no right answer, so here's a menu of factors to consider. If you want an easy life, then an off-the-shelf fund will probably give that to you, because you just buy units in a unit trust, shares in an investment trust company run by a fund manager. However, that's not the full picture. If you want visibility about what's under the bonnet, what's going into that portfolio, then a portfolio that is managed for you or you manage yourself will give you that much more than the fund. Flexibility is important to some people. They want to be able to invest tactically. They want to move in and out of certain geographies, in and out of certain currencies. They want to avoid certain sectors. If that's the case, then something which is a portfolio is much more easy to achieve that with than a standard fund, where you are basically dominated by the decisions of the fund manager. Efficiency, this is and it depends. If you've only got a small amount to invest, either lump sum or regular basis, then a fund will probably work out cheaper. For larger sums, the cost benefit needs to be weighed up more carefully. Other benefits, access. You can, with an advised relationship in particular, dip in to what's under the bonnet and change it. That's not really possible with a standard fund. Tax planning is easier with an open portfolio. That's in terms of capital gains tax planning around the end of the tax year, for example. If it's administration you're after, or candy administration, then a standard fund will probably give you that benefit more readily. So there you have it, a quick snapshot there. Any questions, editor@killik.com. And to watch related videos, please go to our library, killik.com/learn.